you're following along with the book, Chapter 7 is a pretty quick one. It's basically a primer in investing in index funds. Index funds, as we have learned, effectively track certain sectors of the stock market or the entire stock market, depending on the specific types of index funds that you invest in. So if you take a look in that chapter in the book, you'll get an idea of actually how to go in and start investing today, if you'd like. So in that chapter begins by discussing brokerage accounts. Brokerage accounts, sometimes called taxable accounts. These are accounts that aren't eligible for any sort of special tax treatment. So later on in this book, we'll talk about tax shelters, 401ks, IRAs, 403bs, those types of accounts. To have access to those, you generally need to be working, and they may need to be provided by your employer depending on the specific type of account we're talking about. But anybody can open a brokerage account. A brokerage account is basically just a place where you just go invest. It's not connected to any sort of tax shelter or anything. You deposit money and you can start buying stocks pretty much right away. If you use a brokerage account, you do have to become accustomed to how these funds are taxed, which we'll cover very quickly in this book in the upcoming days. And then also you'll have to decide what specific brokerage account to use. You've got to choose a vendor. So a vendor is one of these investment companies. You have to choose one of those investment companies that you will use as a medium for buying stocks, bonds, and other assets. There's a few that I recommend. Fidelity is a good one. Vanguard, Schwab, these are all good ones. I don't get anything from promoting these. It's not my goal to try to, get you to invest in a particular product. I'm just telling you the ones that offer low-cost index funds, which I believe are the best investments you can pick. If I was starting one right now, I'd probably choose a Fidelity account. They have some no-cost index funds, which are really the best products available to invest in that are out there. But don't be surprised if you have multiple accounts. In fact, I have all three of these. When I opened my IRA, the best option at the time was Vanguard. So my IRA is with Vanguard. When it comes to my company-provided plans, I have what's called a 403b and a 457b. Those are through Fidelity. And my brokerage account, which I opened many years ago, is in a Schwab account. So I end up with three different vendors, and it happens to be the three vendors that I would recommend. There are plenty more out there. Robinhood is pretty popular among younger people. Doesn't seem that there's any problem with Robinhood, so that could be a completely viable option as well. These are just three large companies that I trust. So when it comes to investing, we learned about active investing and why I don't advocate for that. We really were dancing around an idea that's of incredible importance in the finance academic setting. This idea of the efficient markets. There's a finance academic named Eugene Fama who popularized this idea of the efficient market hypothesis. And this is the idea that all information that's known about a firm is already priced into that firm. So if we're comparing two different companies, Company A, Company B, and let's say that their share prices are $22 and $18. Now we know share prices are pretty arbitrary, but just imagine, for our example, this is what you see when you log in online. There's different stocks to invest in, and here's two companies that you could choose. Now let's imagine that the stock market is expected to return 10% over the next year. Based on that information, what would you expect Company A to return? What about Company B? The idea of the efficient market hypothesis is you don't actually need to know anything about these firms to answer this question. If the market as a whole is expected to return 10%, then so too will these two firms. To explain why, imagine if we knew they weren't expected to return 10%. Suppose that we somehow knew that Company A was expected to return 12%, and company B is likely to return 8%. If we had some sort of crystal ball and we could see that. Well, based on this information, which of these would you want to buy? You'd want to invest in company A, right? You'd rather have the higher return. And the thing is, there is no crystal ball. We all have the same information. We all can only look at what's publicly available about these companies. And the vast majority of active trading that's happening very quickly in the market is from people that are doing a lot of research. So if we really somehow knew that company A was going to generate higher returns than company B and also higher returns than the market as a whole, people would buy company A, driving the price up until the returns are at the market average. The same is true for company B. If people knew that company B was going to underperform the market, they would sell company B and they wouldn't buy company B. That would put downward pressure on company B, dropping down its price, and now its expected return would be higher because you could invest at a lower cost. So the idea of the efficient market hypothesis is all of these events have already happened. All of this unraveling of prices has already occurred. And so the best guess of what every company is going to do is also the same guess that we should have for the market as a whole. So it doesn't really matter which company you're going to pick. They all have about the same expected return. It's not 100% true. Okay, there may be some loopholes out there where you could find some cracks, some nooks and crannies where people haven't explored fully. But I think it's best that you ignore that possibility because it's not worth your time. You're way better off spending time on other pursuits, and advancing your working career, exercising, things like that, than you are trying to figure out a way to eke a little bit of extra return from the market. Because I don't even know if you'll be able to. You probably won't. And even if you do, you're not going to generate much return from it. Also, risk does play into this a little bit. We learned in the past that small cap and mid cap stocks do outperform large cap stock over the long run. So what we're assuming here in this analysis is that all firms have the same level of risk. In reality, stock companies that have more risk will yield a slightly higher expected return. So the efficient market hypothesis, we can't prove it right. We can't prove it wrong. All that we know is that it is a pretty good approximation of reality. And so if you buy into the general principle of the efficient market hypothesis, even if you don't believe it to be fully true, it leads to a pretty clear outcome, which is you should just buy all the stocks. If every stock yields about the same expected return, then you might as well buy them all because that will minimize risk. And there's different ways to do that. You'll hear a lot of press about S&P 500 index funds. These are just really popular for whatever reason. They've just kind of gathered a grip on the finance community. And they are widely available. There's a good chance inside your 401k and other tax-sheltered accounts, you're going to have an S&P 500 index fund available to you. And what you're looking for is one with a really low fee. Within my HSA, I actually have two different S&P 500 index funds. One offers a 0.05% return, or expense ratio, excuse me. One offers a 0.05 expense ratio. The other one offers a 0.45% expense ratio, and otherwise they're exactly the same. So it's two S&P 500 index funds, and one has a fee that is 9 times larger than the other. So who would choose this one? Idiots. People who don't understand what they're doing, okay? These funds contain exactly the same assets, so you should always choose the one with the lower fee. And that's generally what you're looking for, the lowest possible fee. And when it comes to S&P 500 index funds nowadays, you should be able to find one with an expense ratio less than 0.1%. And lower is always better, but when it comes to things like 401ks, you may not have a lot of options. So you would hope to find one lower than that, but if you don't, sometimes you just have to bite the bullet and accept the fact that you have to pay a higher fee because the tax savings generated by a 401k are worth paying these high expense ratios that could be beyond 0.1%. For these types of index funds, it's very uncommon to see other types of fees, front-end load fees, back-end load fees. You're probably not going to see those. Instead, all you're going to see is just general expense ratios that are hopefully teeny tiny. S&P 500 index funds are fine, but they only contain U.S. large caps. So they're not ideal. So what you might find is, in your 401k, an S&P 500 index fund is the only really good investment. That means you need some exposure to mid-cap, small cap, and international stocks as well. And you can go out there and explore and find different options. And in the book, freefinancebook.com, I actually show you some of these specific ones that you might consider investing in. Ideally, what you'd like to have is some more large-scale investment options, such as total stock market index funds. These are great, but they're unlikely to be found in your 401k, but you can definitely get them in a brokerage account. You could sign up for a brokerage account through, a company like Fidelity, and then within the hour, purchase a total stock market fund, which actually has the one Fidelity offers called FZ-ROX. That's the ticker symbol. You can look it up. It has an expense ratio of nothing. It's free. It's a free total stock market fund. So in just a few clicks, you can invest in the entire U.S. stock market with absolutely no fee, which is really quite extraordinary. And we've really come a long way. 20 or 30 years ago, something like this would have been impossible. So if you have a brokerage account, I would recommend choose one of those three options I discussed before. Find something like FZ-ROX, a total stock market index fund, and you can start investing now and I think sleep well at night knowing you're making better financial choices than the average person is. You could even get broader than that and look for a world stock market index fund. These are quite uncommon, but Vanguard does offer one. That's the ticker symbol, VTWAX. So if you invest in this fund, you're buying the entire world stock market, which if you're going to invest in stock, it can't get any more diversified than that. And this one does have a slightly higher expense ratio, which might scare you away a bit. But still, if you're trying to decide how to invest and you don't want to think too much about it, or you're giving advice to someone else who has never really invested, a really easy answer would be for a young person who can take on risk, just put all of your money in a fund like this. Okay? You might be putting it all into one investment, but it is completely diversified because it contains stocks from all over the world. So you don't need to overthink this. If you want to invest in a brokerage account, choose a vendor. Choose a vendor like Fidelity, Vanguard, Schwab, those that I mentioned before. I'm sure there's others, but that's just a few that I recommend. Make a deposit. Connect your checking account. Typically how this works, connect your checking account to that vendor and you can make a transfer over. This doesn't take very long. Pick an investment. Don't overthink it. Choose something that allows you to broadly invest, like a total stock market fund or a world stock market fund would be even better. And then you can make a market order. So one of the things that can be a little bit confusing if you've never traded stocks is there are a lot of different options in terms of transactions. There's limit orders, stop limit orders, options, all kinds of stuff you can do. What I'd recommend is just make a market purchase. A market purchase means that you're just going to buy at whatever the price is when you hit click. All right, so you're not worried about fluctuations in the market in that very moment that you click. Whatever the price is when you click is what you're going to pay. When you're investing in a total stock market fund or something like that, this is a completely reasonable way to invest. So what you might see is one share is $145.88. You can buy 2, 3, 4, as many shares as you want of that using a market order. And then just leave that sucker alone. Just let it be invested. In a brokerage account, this is really quite simple. What makes things a lot more complicated in the future is when you do start to have those tax shelters like 401ks and HSAs, then it becomes a crazy puzzle that you have to put together, okay? So for example, in my HSA, I only have, the only good thing to invest in is an S&P 500 fund. As I said before, the problem with investing in an S&P 500 fund is you're not getting any smaller mid caps, and you're not getting any international stock. So since all of my money in an HSA is in large US stocks, I now need to figure out a way to invest in small mid caps and international stocks in my other accounts. And that's when the puzzle starts to get a little bit more complicated. But if you're just getting started, keep it simple, use a brokerage account and invest. Or even better, if you're eligible, start using a Roth IRA, which we'll talk about in a later chapter.